Hello, class, and welcome to our third lecture series on international finance. And I'm your instructor, Jamal Haider. So this is a very, good example for you. Sometimes rejection is the stepping stone. So basically, this is the rejection letter of Einstein from University of Bern, in which he was, rejected for the position. And look at that. So you can take a screenshot and you can just read it on your own convenience. It's just a fruitful thought for today. Okay, let's begin. We were discussing the chapter number 2, which is the international flow of funds, and we ended up from the perspective of how foreign funds flow from, how funds flow from one country to another country. And we ended our discussion on foreign direct investment, and we talk about that there are three ways in which you have foreign investment. Number one is the portfolio investments, and then outsourcing, and then physically, acquisition or establishing a company on foreign lands. So I have a very nice video that further, enhance your concept regarding the FDI and the portfolio investment. So some books, they also call this DFI. So don't get just, confused. One and the same thing, direct foreign investment or foreign direct investment. It's one and the same thing, okay? So normally this book says it's FDI. Some other books, they say DFI, okay? Let me show you the video here. I think I need to share this video from you. So can you see the video here?
No.
How can you see that?
Apex Brazil presents.
Right? Can you see?
Yes.
Okay, now let's clarify our concept.
Foreign direct investment. Brazil is the largest recipient of foreign direct investment in Latin America. But do you know what foreign direct investment is? It is the long-term investment in a foreign country. Robert works in a multinational company that produces microchips for smartphones. The firm is based in Europe with factories in Asia and the United States, from where their products are exported to Brazil. Robert is responsible for the opening of subsidiaries to expand the company's global presence. Apex Brazil detected that Robert's company has technologies that would help the development of the Brazilian productive chain in the electronics industry. Apex Brazil contacted him to present investment opportunities in Brazil and the incentives that are available to facilitate the company's production in the country. Like the company where Robert works, several other foreign companies find in Brazil excellent opportunities for investment in sectors such as energy, infrastructure, automotive, medical equipment, semiconductors and biotechnology, among others. Companies also find a favorable business environment for investment with a growing consumer market, abundant natural resources, skilled workforce, a stable democracy, and legal environment. Robert understands this potential and is currently evaluating the best way to invest in Brazil. Some options are considered for the country: the construction of a new industrial plant, the merger or acquisition of a company already operating in Brazil, or a partnership with a local company to offer their products and services in the Brazilian market. Robert decides to visit the country. Apex Brazil offers free support to build relationships with governments, organizations, and companies in all regions of the country. Investors then gain a clearer view of the market, available infrastructure, potential partners, costs, taxations, labor availability, logistics, and compliance to Brazilian norms and regulations. In addition, they have the chance to negotiate incentives and a strategic location for the plant. After rubber stripped to the country, the company decided to invest. Good for them and for Brazil. Foreign direct investment brings new technologies, improves the trade flow and the infrastructure, takes the country to global value chains, generates employment and taxes, and stimulates workforce qualification, helping Brazil to grow. Apex Brazil, promoting investments for Brazil's growth.
So we just saw the video regarding how a business can go for direct foreign investments or through portfolio management, portfolio investments, or through the acquisition and mergers like that. So it's both helpful and it also improves the international flow of trades and of course capital as well, right? Okay, so let's talk about the impact of international cash flows, because this book is basically US centric. So assume yourself that you are in US. So remember, US heavily relies on foreign investments. I think this we already talked about in our previous lectures in detail. So how? Because US manufacturing plants, offices, and other buildings, over there, mostly occupied by the foreign, companies that are listed on the foreign exchange. Plus, debt securities are issued by US firms, right? They are in the possession of foreign countries. Like China invested in the debt securities of US. Similarly, the European Union, Germany. Similarly, the other big countries, they have invested in the debt securities of US firms. Plus, even the government issued debt securities are also owned by foreign governments, foreign countries, or some wealthy investors as well. So foreign investors are especially attracted to US financial market when interest rate in their home country is substantially lower than the United States. So similarly, in US, interest rate is high, of course. If you are in China, so you want to exploit this opportunity to earn more interest, right? So capital will flow from China to US because interest rate in China is high. Sorry, interest rate in US is high, right? Okay, next. So we also talked about this, how the impact of international flow funds affect the business investments and interest rates. So recall your discussion regarding the market forces of demand and supply. So this is supply, this is demand. So if we talk about, and here is the, for example, the price of the money is called interest, and this is the funds available. So if interest right now is here, and what happened? The investor from China, they see that this interest rate is higher, so they provide more funds Let me change color if I can change the color. I think from here I cannot. Okay, don't worry. So they provide more funds to US, and as a result, what happened? The supply of the funds shift to the right. Right? When supply comes shift to the right, what happened? We have a new equilibrium, and that equilibrium is the new price of the money. Right? So funds move from F to F dash and interest to interest 1. So it means interest rate goes down when a country receives more funds, right? What happened to the businesses in US? When interest rate goes down here, what happened? So the demand of funds right? They also increased. So business investments increased, right? So when business investment increased, see here, when business investment increased, so you see here, so this is the connecting one. So long-term interest rate will go down. So this not happen in one day. We talked about the J curve effect. So if something happened now, the effect going to become after at least 18 months, right? So if you see that, if interest rate goes down, what happened to the businesses? They will require more loan and they will expand. New business will come. Every entrepreneur or joint venture, they apply for loans because interest rate is lower, right? In that case, business investment increases. So that also encourages international flow of funds, right? So it's a chain effect. So not only if a country is giving you higher interest rate, it receives on the other hand higher investment in order to from foreign investors, so those who want to exploit this high interest rate. On the other hand, long-term effect is that the interest rate goes down because supply is higher. So in long term, after the J effect curve, passes, interest rates goes down. When interest rates started going down, people are, businesses are asked more loan. New businesses will, establish more. Business expansion is there, and what happened? Business will expand. So due to the foreign investments, the local or our own country started to experience growth, right? So if you understand all this stuff, so let's have the discussion here. So I'm going to give you 15 minutes to answer this, and this is a group activity. Let me establish a breakout room activity. So remember here. So I'm going to create 2 breakout rooms with one group 2. Okay. So we have a new participant. Let me establish what again the breakout room. Meanwhile, please take a screenshot. So all those who are watching online, please pause the video and try to do by yourself. And at the end, when we resume, we will be doing, we will be discussing its solution. So I'm gonna pause our video here. Okay, class, welcome back after the breakout room activity. So we were discussing the class discussion, and which is also the class participation here as well. So we talked about number 1, assume that the dollar is presently weakened and is expected to strengthen over time. So right now our dollar is weak. What does it mean? It means the foreign goods that a US person is buying right now, it's more expensive. If you are in US and your currency is going down, so it looks more, sorry. So for you, the foreign products looks more expensive to you, right? So what if you invest in another country right now, your dollar is weak and you invest in China, and what are the expectations after some time? The expectation is that the dollar will increase, which means yuan will decrease. So you will be hit by double, double loss. First, you converted more dollars with less yuan because your currency is now at this moment at 0.0. Your currency is depreciated, and it takes more dollars to convert into yuan to invest in China. And what happened after some time when you are harvesting your investment? So Chinese yuan goes down, because we just talked about that between 2 currencies, US and yuan, if